Good morning. Welcome to the Global View on this Monday, the 25th of September. So we're looking beyond the ASX listed universe, as it's good to do sometimes when you're in the money-making business. I'm your host, Nadine Blaney. Just a little bit of an update on some of the data. We saw the US dollar advancing as PMI data on business activity from right around the world to end the week really did highlight the superior US position relative to other major economies. You can see it there in black and white, really. The US Federal Reserve on Friday also was warning of further rate hikes. Fed Governor Michelle Bowman said inflation is still too high, saying that progress likely to be slow given the current level of monetary policy restraint. She also pointed to the rise of energy prices as a risk. Boston Fed President Susan Collins says she expects rates may have to stay higher and for longer than previous projections suggested. Also heard from Mary Daly, who called it prudent for the Fed to be patient in future rate decisions. Oil prices rose, again concerns from Russia's fuel export ban countering demand fears driven by macroeconomic headwinds and higher rates. There's Brent. Fell just slightly to settle at 93.27 by the end of the session. Benchmark 10-year Treasury yields hitting a 16-year peak and remaining around there. Gold prices on Friday just edged a bit higher, helped by a slight pullback that we saw in those bond yields. So if that's the backdrop, let's find out what it means for you as investors. Anthony Doyle from Firetrail is joining me now. Anthony, hi.
Morning.
Okay, inflation. Shall we talk about it? We've got the PCE deflator coming up this week. Is the Fed nearing success? I mean, all those Fed speakers sounded very cautious.
I think the story of the last 18 months, Nadine, has very much been one where the bond market has sought to price in interest rate cuts very rapidly, and they continue to get priced out longer and longer as economic momentum surprises on the high side. So it's not surprising only the bond market, but also central bankers, particularly in the United States. The labour market has been far more resilient to the rate hikes that we've seen than had previously been anticipated. Wage increases and wage growth has been relatively strong, but we have seen headline inflation return back to more comfortable levels for the Federal Reserve.
But we're not talking about immaculate disinflation anymore, are we?
No. I mean, for a long time, the concerns in markets were that it is very difficult to engineer a slowdown in growth without a rapid rise in unemployment, and that was going to result in a severe recession. And cast your minds back only to January, where we had obviously the concerns around Credit Suisse, acquired by UBS, and of course Silicon Valley Bank as well. So immaculate disinflation at the headline level, perhaps. At that core level, it's certainly a bit more sticky and a bit more harder to budge.
And then you overlay energy and what's happening with the price of oil right now. So when it comes to the data this week, and I'm talking about the core PCE deflator, is this the week where it pretty much gets determined whether or not we see a hike coming through this year?
It's probably a 50-50 call. So November, in terms of the percentage chance of a rate hike, is 50-50 at the moment. And we're getting back to the days of last year where the market was putting so much emphasis on one data point. So if you see core PCE, particularly given the language out of the Federal Reserve last week, surprise on the high side of market expectations, you'll probably begin to see a hike begin to be priced into the bond market. If you see it equal or lower than market expectations, well then the Fed may actually have room to pause for an even longer period than they have done thus far.
Okay, so when you are thinking about all of this as an investor, I mean, we've got quarterly earnings coming through in the US. Will that be a determinant of what happens in equity markets between now and December, or are we looking to the bond market?
No, I think it'll be key. Earnings will be key. So last year characterised by macro, this year characterised by bottom-up idiosyncratic risk. And it's really been earnings that has driven the fantastic performance that we've experienced in the US S&P 500. So we're talking about 22% uplift this year, really confounding most strategists' expectations. So we are putting a laser-like emphasis on earnings as we do at Firetrail in terms of our outlook for companies. And what we've seen this year is really that bottom-up stock selection driving returns rather than is inflation higher or lower than expected?
Yeah, I like that idiosyncratic bottom up, because even if you think about the components of the S&P 500 that have really driven the bulk of the index rally, it's been the Magnificent Seven, But does that mean that where have you been looking for other opportunities then?
Yeah, so our real emphasis this year has been outside of those Magnificent Seven stocks. So we have exposure there via Alphabet and Microsoft, but overwhelmingly the alpha in our portfolio has been driven by stock selection lower down the market cap spectrum. So in the mid cap and small cap part of the US market in particular. These are where we think the really significant opportunities lie with a 5-year investment time horizon, particularly when you consider that many of the companies that we are most excited about are nearing the end of or have just finished a CAPEX cycle. And so we're starting to see a strong emphasis of capital being returned to shareholders, either via share buybacks, but equally via dividends as well.
Okay, how important are dividends right now?
So in the US, it's very much been share buybacks. So we're seeing good companies, particularly the management teams, that are viewing their share prices as undervalued. They have been undertaking with any sort of free cash flow or EBITDA, they've been undertaking share buybacks. And obviously the emphasis in Australia, very much on income and dividends because of the favourable tax treatment of fully franked dividends. So there is an environment of higher costs of capital today, and we are seeing management being far more selective with any sort of infrastructure spend or CAPEX spend that they're undertaking. And if they can't find projects to invest in, and we have significant hurdles for those projects, then they are returning that cash to shareholders, being accretive to the share price.
But let's just rewind a moment, because you said that you're interested in companies that are nearing the end of a CAPEX cycle, presumably because they will stand to benefit and they won't have that capital outlay going forward. Like what?
Well, I have today a German company for you, but the majority of its revenue is derived from the United States.
Okay.
This company you may have heard of, Hellofresh. So it's a German company.
I'm not completely ignorant that I didn't realize that it was a German company.
Yes. And so they've just undertaken a CAPEX spending program to expand the capacity of their delivery kits. And they've come to the end of that cycle now. So that should resolve some of the supply constraints that they've had. A COVID winner, sold off and up 15% over the course of the last month. That was one of the top contributors in our portfolio in August.
So you're not at all, has Hellofresh established such a base and such a presence in the States that you're not concerned that it still is a bit of a fad?
No, we see this trend as a secular trend that is continuing, and we saw the IPO of another home delivery kit maker last week, and the shares popped on the issuance date as well. So with the outsourcing trend likely to continue, particularly amongst the consumer base, it is very well established. And what Hellofresh are telling us is that their users, when they do subscribe to Hellofresh, they are very, very sticky. And Hellofresh have been very successful in converting those trial programs that you may have seen into long-term users of their products.
Right. Okay. Is there another company, in a different sector? Because are you sort of agnostic when it comes to thematics like AI and all that kind of stuff? Will you look across the spectrum? Financials, where?
Absolutely. So it's an unconstrained approach that we follow, and we're just looking for the 30 best opportunities in the global market today. And what we're looking for are companies that share characteristics of a sustainable business model, delivering sustainable earnings and driving sustainable change. So another company, for example, is US listed IBKR. And so IBKR are a brokerage firm, and they are driving lower and lower costs across the marketplace. Now, what's interesting about IBKR is that because of higher interest rates, they're generating higher interest income, but they like to share those higher revenues with their investors as well. So they are taking a spread, but they pay much more attractive interest rates relative to the other online peers. And they have been very successfully rolling out white labeling of products as well.
This is Interactive Brokers, is it?
Correct, yeah,
right.
Interactive Brokers,
Okay.
Absolutely. So another key contributor to performance over the course of the last 6 months or so.
I think I'm going to push the friendship then, because everything's good in threes. Is there another company in the portfolio that you think is, good still now?
Yeah, well, we've obviously seen higher higher oil prices.
Yeah.
And so we think creatively about how can we get exposure to that higher energy price complex. Yep. Now, particularly with the weather that we've been experiencing here in Sydney as well, Nadine, with the hot weather, El Nino recently has been declared as well here in Australia. That's likely to have upward price pressure on food prices, for example. And so when you consider and look around the world, who could potentially benefit from higher food prices? Well, Archer Daniels Midland, an agricultural behemoth. And when I talk about the higher energy price complex, they are crushing soybeans. So the meal is used for agricultural feed and the oil is used to generate things like sustainable aviation fuel, for example.
Okay, well, only because we're out of time, I'll have to let you go. But Anthony, it's always good to have a chat. So just one final question. So your view is that we may see another interest rate hike coming from the US Fed this year, or do you think it's pretty much baked in?
I mean, whether there's one more or not, what we do think is going to occur is that interest rates will be higher for longer. Okay. And so, again, that emphasis on being judicious with how you are investing within a company is likely to come to the fore. So certainly the days of there is no alternative likely behind us. And I think this is the era of active stock picking.
Got it. Thanks for the headline too. It just wrote itself. Anthony Doyle there joining us from Firetrail. Always worthwhile. The local market is expected to come under pressure today upon open in just a couple minutes, down by 18 points. So we'll be keeping an eye on that. And I think that this tweet kind of goes really nicely with this conversation I had with Anthony. So, the S&P 500, excluding 7 technology stocks, now up just about 4%. So combined, the S&P 500 as a whole is up by 13%. So if you buy the S&P 500 index today, you're basically buying a handful of companies that are driving the entire market. So if you put it all into perspective, a lot to get through there, but this entity is saying, what happens if the AI hype fades? So consider your stock picking accordingly. All right, that does it for this edition of The Global View. Stick around, we'll bring you through the open. Trades getting underway shortly.